Let me start with a quiet truth most investors don't want to hear. The market does not destroy people. Crashes don't destroy people. Recessions don't destroy people. What destroys investors is what they do before the crash and what they keep doing after the warning signs appear. Most people imagine failure in investing as something dramatic, a sudden collapse, a big red chart, a single terrible decision. But that's not how it usually happens. In reality, investors are rarely killed by one mistake. They are slowly worn down, day by day, habit by habit. Charlie Munger never believed that success came from brilliance alone. He believed it came from avoiding stupidity. He didn't ask, "How do I get rich fast?" He asked, "What mistakes will quietly take me out of the game?" Because investing is not a sprint. It's not even a marathon. It's survival. If you stay in the game long enough, returns compound. If you get forced out, nothing else matters. And yet, most investors focus on the wrong things. They obsess over predictions. They chase forecasts. They debate interest rates, CPI numbers, and next quarter's earnings. Meanwhile, the real dangers are much closer. They live in your habits, in your reactions, in the stories you tell yourself when nobody is watching. The truth is uncomfortable. Most investors don't lose money because they chose the wrong stock. They lose money because they couldn't control themselves around the stock. They confuse activity with progress. They confuse confidence with competence. They confuse intelligence with discipline. And over time, these small confusions add up. Not fast, not loudly, but consistently. The market doesn't need to attack you. You slowly hand it the weapon. That's why this episode is different. We're not going to talk about what to buy. We're not going to talk about timing the market. We're not going to talk about beating an index. Instead, we're going to talk about the 5 things that quietly destroy investors. The habits, the mindsets, the invisible errors that don't look dangerous at first. These are not dramatic mistakes. They don't make headlines. They don't feel reckless when you're making them. They feel reasonable. They feel smart. They feel justified until one day you look back and realize you didn't lose because the market was unfair. You lost because you stayed exposed to the same errors for too long. Charlie Munger once said that a lot of success in life comes down to not being stupid. Not all the time, just often enough. So if you want an edge in investing, don't start by asking how to be brilliant. Start by asking how to survive. Because in the market, the people who last are the ones who avoid the mistakes that force everyone else out. And once you understand that, the real game finally becomes clear. The first thing that quietly destroys investors is something that looks like an advantage. Intelligence, not ignorance, not laziness, but intelligence mixed with confidence. Smart people often believe they are less likely to make mistakes. They understand numbers, they read books, they follow markets closely, and that's exactly where the danger begins. Because intelligence does not protect you from bad decisions. It often gives you better excuses for them. You don't panic. You rationalize. You don't gamble. You optimize. You don't speculate. You have a thesis. This is how overconfidence hides, not as arrogance, but as logic. Charlie Munger warned repeatedly that smart people are especially vulnerable to this trap. Because once you believe you're above average, you stop questioning your own judgment. You start trusting your explanations more than the evidence. When something goes wrong, you don't ask, "Was I wrong?" You ask, "Why the market doesn't understand yet?" And that single word, yet, can keep you trapped for years. Overconfidence changes how you handle risk. You concentrate more. You leave less margin for error. You believe downside scenarios are unlikely because you've thought things through. But the market doesn't care how carefully you thought. Reality does not reward confidence. It rewards accuracy and humility. The most dangerous phrase in investing is not, "This can't fail." It's, "I understand this well enough." Because the better you are at explaining something, the easier it is to ignore warning signs. Price drops become noise. Contrary opinions become ignorance. New information becomes temporary. And slowly, your position becomes your identity. At that point, you're no longer managing risk. You're defending ego. This is why many brilliant people underperform. Not because they lack skill, but because they trust it too much. They mistake intelligence for immunity. But the market doesn't punish stupidity the most. It punishes unchecked confidence. The antidote is not pretending to be dumb. It's building systems that assume you will be wrong. Lower position sizes, clear exit rules, time delays before action, humility built into structure. Because the smartest investors are not the ones who feel confident all the time. They're the ones who design their behavior around the fact that confidence is unreliable. In investing, being smart helps. But believing that you are too smart to fail is often the first step toward failure. The second thing that quietly destroys investors is the addiction to activity. Doing something feels productive. Sitting still feels irresponsible. So investors trade, they adjust, they tweak positions, they respond to headlines. Movement becomes comfort, but the market does not reward motion. It rewards positioning. And those are not the same. Charlie Munger often joked that the big money is not in the buying and selling, but in the waiting. Most investors hear that and nod, then go back to checking prices. Because waiting feels passive. It feels like falling behind. So activity becomes a substitute for patience. You rebalance too often. You trade on news you already half understand. You react to volatility as if it demands a response. But volatility is not a call to action. It's a test of temperament. Activity addiction usually starts innocently. You tell yourself you're staying engaged, you're being responsible, you're managing risk. But over time, activity becomes noise. The more you do, the more chances you give yourself to make small errors, and small errors compound too. Transaction costs, taxes, timing mistakes, emotional fatigue, none of them feel fatal, but together they quietly drain performance. The market has a strange asymmetry. Doing nothing is often the hardest decision and also the most profitable. Yet many investors cannot tolerate inactivity. They feel anxious when nothing is happening, so they create something to react to. This is how motion replaces thought. You stop asking, "Is this change necessary?" and start asking, "Why not do something?" But the absence of a reason to act is a reason to stay still. The investors who survive long enough to win are not the most active ones. They are selective. They wait for situations where action is clearly justified, and in between, they do very little. They design their portfolio so boredom is a feature, not a bug. Because the real danger is not missing a move. It's overreacting to noise until your edge disappears. The market does not punish inactivity. It punishes unnecessary activity. And once you understand that, doing less starts to feel not lazy, but disciplined. The third thing that quietly destroys investors is ignoring incentives and human nature. Most investors believe they are rational. They trust data. They analyze numbers. They build models. And yet, again and again, they are surprised by behavior. They ask, why would management do that? Why would analysts miss this? Why would the market react this way? The answer is usually simple. Follow the incentives. Charlie Munger said it plainly. Show me the incentives, and I'll show you the outcome. But investors often do the opposite. They assume people will act logically even when logic is not rewarded. Executives are paid to hit short-term targets. Fund managers are judged quarterly. Media companies are paid for attention, not accuracy. And investors themselves are rewarded emotionally for being right, not for being patient. None of this is hidden, but it is often ignored. You read earnings reports without asking how bonuses are structured. You trust forecasts without considering what happens if they're wrong. You listen to confident narratives without asking who benefits if you believe them. Ignoring incentives creates blind spots. You assume alignment where none exists. You assume honesty where image matters more. You assume long-term thinking in systems built to reward short-term results. This is not a moral failure, it's a structural one. People respond to what they are paid to respond to. And if you don't account for that, you end up surprised by outcomes that were actually predictable. The same applies to yourself. You think you're managing risk, but are you rewarded for caution or for feeling smart? Do you hold a position because the fundamentals are strong or because selling would mean admitting you were wrong? Human nature does not disappear just because money is involved. In fact, it becomes stronger. Ego, fear, status, career risk. All of these influence decisions far more than spreadsheets do. Investors who survive long-term don't assume people will act in the best interest of shareholders. They assume people will act in their own best interest. And then they adjust accordingly. They demand a margin of safety. They discount narratives. They stay skeptical of incentives they don't fully understand. Because once you see incentives clearly, behavior stops being confusing, and investing becomes less about prediction and more about avoiding predictable mistakes. The fourth thing that quietly destroys investors is the absence of margin of safety. This one doesn't feel dangerous at first. In fact, it often feels efficient. You concentrate positions. You optimize returns. You assume your analysis is accurate enough. After all, if you've done the work, why leave room for error? Because error is not optional. Charlie Munger believed that the future is always uncertain, not occasionally, always. And margin of safety is how you survive that uncertainty. Most investors don't fail because they are wrong once. They fail because they are wrong without enough room to recover. A little too much leverage, a little too much confidence, a little too much optimism built into the assumptions. Nothing breaks immediately, but when the unexpected arrives, and it always does, there is no buffer, no flexibility, no time, no second chance. Margin of safety is boring. It means holding cash when returns look attractive elsewhere. It means smaller positions when conviction feels high. It means accepting lower upside in exchange for survival. And that's why many investors ignore it. They see margin of safety as inefficiency, as wasted potential, as fear. But in reality, it is humility in structural form. The market does not care how reasonable your assumptions were. It only cares whether you can stay solvent when those assumptions fail. Without margin of safety, every mistake becomes fatal. A missed forecast becomes a forced sale. A temporary drawdown becomes permanent loss. A normal cycle becomes an exit. Investors often ask, how much can I make? Better investors ask, how much can I lose and still stay in the game? Margin of safety answers that question. It buys you time. It buys you optionality. It buys you the ability to be wrong without being eliminated, because in investing, being wrong is inevitable. Being unable to recover is optional. And the investors who last long enough to win are not the ones who avoided mistakes entirely. They are the ones who built enough margin to survive them. The fifth thing that quietly destroys investors is short-term thinking in a long-term game. Most people say they are long-term investors, but very few behave like one. They check prices daily. They react emotionally to weekly moves. They lose patience after a few quiet months. Their words are long-term. Their behavior is not. And behavior is what matters. Charlie Munger understood something simple but uncomfortable. Compounding is slow, and the human mind hates slow. Nothing seems to happen for long periods of time. Returns feel disappointing. Progress feels invisible. So investors start to doubt. They question their thesis too early. They abandon strategies before they have time to work. They switch approaches just to feel movement again. But compounding does not reward impatience. It punishes it. Short-term thinking shows up in subtle ways. You judge decisions by recent outcomes, not by process. You confuse volatility with failure. You expect meaningful results on a timeline that was never realistic to begin with. A great investment can look terrible for years. A terrible investment can look brilliant for months. The market does not reveal truth quickly. It reveals it eventually. And that delay is what eliminates most people. They don't fail because their ideas were wrong. They fail because they couldn't wait long enough to find out if they were right. Short-term thinking also creates emotional fatigue. Every headline feels urgent. Every drawdown feels personal. Every rally feels like proof. Your mood starts moving with the market. And once your emotions are tied to price, discipline disappears. Long-term investing requires emotional distance, not indifference, distance. It requires designing a strategy that does not need constant validation. Because the real advantage of long-term thinking is not higher returns. It's fewer decisions, fewer moments where fear or excitement can push you into a mistake. The investors who survive and win accept boredom. They accept uncertainty. They accept long stretches where nothing feels rewarding. They understand that time is not something to fight. It's something to harness. And the moment you truly think long-term, many of the market's daily noises simply lose their power over you. When people talk about investing, they often talk about brilliance. They talk about finding the next great idea, the next big winner, the perfect strategy. But Charlie Munger never framed the game that way. Charlie Munger believed that success in investing was less about being extraordinary and more about avoiding what is obviously wrong. Because the market is not a fair test of intelligence, it is a test of endurance. You don't need to be right all the time. You don't need to predict the future. You don't need to move fast. You need to stay in the game. Most investors are eliminated not by one dramatic decision, but by a series of small, avoidable errors. Too much confidence, too much activity, too little understanding of incentives, too little margin for error, too much focus on the short term. None of these feel fatal when they happen. That's why they're dangerous. They feel reasonable. They feel justified. They feel intelligent. Until one day, the account is smaller, the options are fewer, and time is no longer on your side. Survival is not exciting. It doesn't make headlines. It doesn't feel heroic. But survival compounds. If you avoid being forced out, time does the rest. And that is the real edge. Not genius, not speed, not certainty, but durability. The ability to endure uncertainty without breaking discipline. The ability to be wrong without being ruined. So if there is one lesson to take from a Charlie Munger, it's this. Don't try to be smarter than the market. Try to be harder to kill. Because in the long run, the investors who last are the ones who quietly avoided the mistakes that everyone else kept repeating. And once you do that, winning becomes much less mysterious.